Welcome to your economic policy making lecture. So we're going to be focusing on fiscal policy and monetary policy and the roles they play in the economy. So this is kind of the government's role in the economy. We got to cover some basic general concepts. So first and foremost is the term budget. This is a document created by Congress that is going to take all the money that the government brings in through taxes and other revenue sources and how we're going to spend it. We have you have another lecture video on the budget process, so make sure if you haven't watched it that you've watched it as well. You have appropriations. This is the official dividing up of the money. It's done through lawmaking, and this is the dividing up of money into the various programs that the federal government is running, and for various projects that they have established through those programs. So Department of Defense, the Department of State, EPA, National Endowments for the Humanities, NASA, CIA, those sorts of things. So the appropriations is the actual authorization of money to all of the various agencies in the government. Fiscal policy is the taxing and spending of the federal government. So this is the money that they bring in through taxing and spending. And, this changes every year, and it's done by Congress. And then finally, monetary policy. Monetary policy is the control of the money supply, and interest rates. So they're going to, this is where the federal government, through the Federal Reserve, is going to control how much money is available in the economy, essentially to pay for loans, for businesses to pay employees, those sorts of things. If you want to go get a home loan, a car loan, a private loan for college, all of that would be involving the monetary policy, and it's through the manipulation of interest rates. Finally, deficit. This is a deficit is how much money the federal government spends in a given year that they don't raise. So this is the money that they spend that they can't cover, and essentially will have to borrow money to cover that cost, but that is deficit. And then when we talk about debt or the national debt, this is all the years of deficit that we have all put together, and this is our national debt that we have borrowed and we have not paid back yet. All right, so let's get into kind of the nuts and bolts. Some of this will be a review if you've watched the budget video. If you've not done that, when you watch the budget video, it'll be a review kind of there as well. So rationale, let's talk about the rationale for a tax policy. So what is the purpose of a tax policy? Well, one, we want to do revenue. We have to pay for services, and so we're going to get that money to pay for services through tax policy. We're going to manipulate behavior. So sometimes we use taxes to manipulate a person's behavior. So we're going to put a tax on cigarettes to try to discourage people from smoking cigarettes, which then in the long term would cut down on healthcare costs that the government would have to pay for Medicare, Medicaid, those sorts of things. You might have an alcohol tax. So sometimes when people talk about like we're going to manipulate behavior, you're doing a sin tax. So in some states or in some cities, they've attempted to try to do what's called a sugar tax. So they put a tax on all large soft drinks to try to encourage people not to drink those, to have a healthier lifestyle. And the last reason we have for rationale for the tax policy is to subsidize. So we're going to subsidize the people's lifestyle. So I, as a homeowner, get to deduct my property taxes from my federal taxes. So the state gets some money, but they're going to subsidize me paying for, or encouraging me, to have a home loan. I get to deduct my property taxes. I get to deduct my mortgage interest. If I have college loans, you get to deduct that interest from the interest when you start paying it back. You get to deduct that from your federal income tax. You're subsidizing people to try to better themselves, to invest more in the economy. So you do that through home ownership and college education. types of taxation. So you have a progressive tax where the more you make, the higher the percent tax you pay. So a person who makes over $500,000 in this year in this country are going to be at a tax at a higher tax rate than someone who only makes $50,000 a year. That would be progressive. Versus a regressive, meaning the less you make, the higher percent of your income is going to taxes. So you make less money, so then more of your budget is going towards these taxes on a regressive tax basis. It's not that you have a higher tax rate, it's just they're taking a bigger percentage chunk than otherwise. And then there's a couple of theories for fiscal policy. So the first one is Keynesian theory of economic or fiscal policy. And this essentially means that that the government should step in to help the economy out when it's struggling. So we're in a recession or depression. So they will step in and do infrastructure type of projects to essentially help people get back to work, because they're going to be infusing money. They're like, oh, we're going to build roads or sidewalks or dams or, other types of sewage treatment plants. They're going to give money for those type of projects that then will in turn put people to work and help kind of pull us out of a downturn in our economy. And then when the economy is doing well, under a Keynesian theory, the government would step out of that role and let just regular businesses and cities and whatnot decide what they were going to do. The other theory of economic or fiscal policy, is supply side. It's also known as trickle-down economics or Reaganomics, because President Ronald Reagan was very positive on this theory. But essentially this means you're going to give tax cuts to businesses and the wealthy, but business owners essentially, and with the belief that they will then take that tax cut money that they are not spending in taxes and reinvest it into the company and hire more people or expand their business somehow, that then the workers would earn more money. Either more people would be getting put to work, which would help drive the economy because more people are, lower unemployment, or you would be paying your current workers at a higher rate. So they would get more money, which then means they can go out and spend money. So that would drive the economy as well. Both of these have some negatives and cons with that. With Keynesian, a big concern is, would the government know to step out of the economy when it started to recover from the recession? Would they do that? And the con on the supply side is we are relying on businesses to reinvest that money, to do the reinvestment and to pay workers more or hire more workers and expand their business, and not instead pocket that money or pay back their stockholders or buy back stock and instead reward their stockholders. So both of them have some cons, and so it is a debate in this country of which one is better. All right. So the political actors in fiscal policy. You have Congress. Congress is, a heavy hitter on the fiscal policy because they're the ones, it's a law, so it has to go through Congress. So first you have your committees. There are certain committees that are involved here under Congress. One of them is the House Ways and Means, which is your tax committee on the House side, and the Senate Finance. Very important in players in this, because they're the ones who are going to be dealing with the tax side of things. You then have the House Appropriations and the Senate Appropriations committees. They're the ones who are actually doing all the actual budget writing. Here's how much money each department gets and how much of that money has to go to certain projects within that department. And then you have the House budget and the Senate budget. They are the ones who create the reconciliation, the framework of here's the overall amount for each of the areas of government. And then congressional staff. So there are staff areas that are involved here. The CBO, also called the Congressional Budget Office, they are the ones who are going to estimate how much these projects are going to cost. And there is a rule in Congress that any new project that is created, the CBO has to come in and has to give they have to do all their research, and they have to give their estimate of how much this project is going to cost over the next 10 years. And if they don't, it's a big, huge concern. It can come back to hurt elected officials when those costs are too far off. And then you have the GAO, also known as the Government Accountability Office. Originally, it was called the General Accounting Office. And this is the group that after a project is put in place and they start applying money to that project and it's starting to be completed, then the GAO actually goes in and looks at the actual cost. So as the project is going on, we get to compare it to what the CBO estimated and how accurate they were, because the GAO are the bean counters. Here's how much this project's actually costing. And then the president. The president is involved here. He offers the initial proposal, but Congress doesn't have to take that proposal. A lot of times, it's a wish list for the president and the executive agencies of what they would like to see in the budget. The president uses the OMB, or the Office of Management and Budget, to kind of create his initial proposal. Here is what we want. Here is how much we are thinking it's going to cost. OMB is going to make any president's projects that he wants look good. Like, they're going to take the lower end numbers to try to encourage Congress to pass them. CBO is much more accurate because it is more nonpartisan, and they're not trying to make a certain one individual look good in their proposal. So the official budget here, you have mandatory expenditures. This is where you have to spend money. Okay, they have to spend money here. You have to pay for these. You have to account for them. And what are those? So I've given you the definition there. Interest on the national debt. We have to cover the interest on that national debt, like all the money that we've overspent for years and years and years. We have to cover the interest on that. Every year we have to cover it. We have to cover the entitlements. The entitlements would be Social Security, Medicare, Medicaid, food stamp programs. I think I give you those. So this is Social Security, Medicaid, Medicare, and other welfare programs. So these have to be covered as well. And yes, they're called entitlements because people have paid into them. Like, when you have a job, part of your taxes are going to Social Security, part of your taxes are going into Medicare and Medicaid and other welfare. Like, you are prepaying in case you ever need them. And if you don't ever need them, you're prepaying to help cover other individuals. So it's a society safety net here. So it is not like a handout. It's a safety net on these items here. Then it is 65. It's about 63 to 65% of the budget are our entitlements. So this is where our largest percent of the budget is going to, and that is the reason why there are people who always look at it and say, how can we get the budget under control? And they want to look at Social Security, Medicare, Medicaid, but these are popular programs that if you cut them, make the people who are supporting that cut unpopular and will struggle to get reelected. So people say we need to do something about them, but then we don't. Discretionary spending is basically the spending that the Congress has a choice in whether or not they fund. All right? They don't have to fund everything else in the budget. So obviously, if it's all other spending. This is defense, this is CIA, FBI, border security, this is agriculture, food safety, education, grants, those sorts of things, national humanities for the arts. This is typically where they're going to cut the budget. This is where they're looking because it's easier here. But it's only a third of the budget. It's like 35% of the budget. It's hard to make the budget balance when you have such a small portion of the budget available to deal with. And oftentimes you'll hear lawmakers go, well, maybe we won't fund the National Endowment for the Arts or the Humanities. That is like 0.1% of the budget. Like, that's not going to do a major impact on the overall budget and the deficit that we are running. The other lever for the economic policy in this country is monetary policy. So our monetary policy is the control of the money supply control and interest rate adjustments. So it is about controlling how much money is out there to be loaned and to be used by people through various levers, one of which is the interest rate. Inflation, this is where the price of goods go up in relation to money. So the price of goods is increasing, but the value of our money is decreasing. And so this is not a good thing. It will take more money to buy the same amount of goods. And typically we have about a 2%. They want to maintain it at about 2% of inflation from year to year to have a healthy economy. Goods are going to cost more typically because technology is advancing, those sorts of things. So that's going to happen. But inflation is the rise of the price of goods. So if there's a decrease in the dollar value, so if the dollar value goes down, like on the world market, then it's due to an increase in available money. So if they've tightened up the money supply, then the value of the dollar is going to come down. Deflation is a decrease in the value of goods and services. So then you don't need as much money to buy those goods, but that's not good for your economy either. So they've really got to try to find a perfect balance between inflation and deflation. Deflation tends to be, if we're going in, if we're having troubles like a recession. So political actors and monetary policy, Federal Reserve. The Federal Reserve is an independent regulatory commission. I know we haven't talked about these in detail yet because we're not to the bureaucratic agencies yet, but understand, independent, key there, means that they have very little oversight from the president. They operate kind of independent of the president, and they are kind of insulated against political pressure. But they're a regulatory agency, so they will, they can regulate things. They can they can create laws and regulations for people to follow. And it's a commission, so there's a group of them. It is chaired by a single person who gets a 4-year term. That also makes them independent because it's not a straight a political appointment. The president cannot fire at will on this group. And then you have the rest of the board, the governing board. There are that run on a 14-year terms. All right. Then you have tools for the monetary policy. So what do they do to try to control the money supply in the country? One is they will adjust the federal funds rate or the discount rate. This is the interest rate. So the federal government will loan money to businesses and corporations and banks. And of course, if they're loaning money, they're going to charge an interest rate. They're going to make money off that loan. And so if they want less money out there in society, out there available, like they need to tighten up the money market, then they will raise the interest rate. So now those banks, corporations, businesses, it's more expensive for them to borrow money. So they'll borrow less. So there's less money for them to use to build new buildings or to do some sort of investment or to loan out to customers for homes and businesses and loans or car loans. Okay, so that is the interest rate. You then also have the open market operations. So the open market interest operations is bonds. So if the government wants to pull money out of the money supply, then they will offer bonds. And so people exchange, and so the federal government will pull money out of the money supply through bonds, and that tightens up the money because there's less money to be available to be loaned and to be used for economic purposes. If they want to loosen up the economy, then they will buy back those bonds and push the money back out into the system. And then the final one is the reserve rate. This is the amount of money that the individual banks have to keep on hand. So every deposit that a bank gets, they have to keep a certain percentage of it in their vault. The rest of it can all be loaned out. Currently, the percentage, I believe, is 5%. It fluctuates from time to time. If they require banks to hold on to more money, a higher percent of their deposits, then that is less money the bank has to loan out. All right. So if you want to if the Fed feels that the economy is too hot, it's growing too fast, because it's one of those things that if it grows really fast, it means it's going to come down really hard. And so they want to kind of temper it. They want growth, but they don't want it super explosive, and they don't want it super slow. They got to find this kind of the sweet spot. So to do that, if they feel like it's growing too fast, they will raise interest rates, or they will issue bonds and pull money out of the supply. So there's less money to go around to be loaned and to be used. Or they will require banks to hold on to more money. If they feel like the economy is not growing enough, or we're officially in a recession, we're contracting, or God forbid we're in a depression, then they will try to push money out into the system by lowering interest rates, making it cheaper for banks and corporations to borrow money. Or they will buy back those bonds and push that money back out into the system, or they will ask the banks they will tell the banks they don't have to keep as much money of the deposits in their vaults. All of that will affect how much money is in the money supply and how much money is out there to invest in businesses, to loan to people to buy homes and cars, and get a credit card to buy appliances for their house. All right, so that wraps up the economic policy. If you have any questions, come see me. And remember, don't do anything too stupid. Bye.